Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and it's been a while since we've taken a look at any REITs. So in today's video, I want to cover two REITs specifically that I like a lot, own in my portfolio, and think might be trading at a pretty good valuation right now. Also, if you do make it all the way to the end of the video, I do have a bonus REIT for you guys to consider as well. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now with that being said, let's jump right into the video, and the first REIT I want to focus on today is Realty Income, ticker symbol O. Now if you guys have been keeping up with the channel, you'd know that I have been covering this stock extensively over the past couple years, and I do own a pretty sizable position within my Roth IRA, and I'm a pretty big fan of the company. Now if you do own the stock or follow it yourself, you do know that their performance has been pretty subpar over the past couple years, but there could be a chance for it to recover in the future. Now both the REITs I do want to focus on today do operate triple net leases, which means that the tenant does cover the majority of the costs. Before we jump in and take a look at Realty Income's investor relations page and some financial stats, let's first take a look at their performance, because a lot of you guys do like to see the performance first as a quick overview on how the company has been doing. So for Realty Income, I'll be honest, it has not been great. Taking a look at the 6-month time frame, they're down 5.64%, and in the past year they are positive, but not by much. At some point during the year, it was actually trading pretty high at $67 per share, which gave it some pretty nice gains, over 15%, but since then it has come down pretty significantly. Jumping into the 5-year time frame, we can see that it has not been forgiving for them, and a big reason for this is really just the interest rates that they have been facing. In order to continue acquiring more companies, which are expensive, the company does have to leverage debt, and that's been pretty tough on them. With the interest rates being higher, their interest expenses have gone up significantly. Because of this, REITs like Realty Income have been diluting their shareholders by releasing more shares into the open market in order to raise capital for their investments. Now that does put downward pressure on the stock price, because as they release more shares and there's more shares outstanding, the funds from operation per share will of course go down, or at least have a harder time going up. That is the main metric you want to consider when looking at real estate investment trusts. Now, as we get further into the video, we'll cover my thesis in more depth, but my main theory behind investing in REITs right now is as the interest rates do come down, which eventually I do believe they'll come down significantly, though it might take a while, I think the stock price for these companies will go up pretty significantly as well. Right now, interest rates are an enormous headwind on these kinds of companies, but as that goes away over time and the interest rate does come down, I believe the company's stock price will jump significantly. In the meantime, we're going to keep having to deal with what we're seeing here. The company's traded $70 per share, and now 5 years later, it's still in the negative, so it has been, of course, a pretty poor investment. Now, what I do want to mention is that REITs do happen to be very good dividend payers, and if you've been holding the stock for this entire time and reinvesting those dividends, your returns have actually not been negative. With their 5.17% current dividend yield, that would put you on the green, but not by too much. Now, I do want to put the max time frame here because I do want to show you that outside these past couple of years, the company has actually been a pretty strong performer, outperforming the S&P 500 over much of this time frame. So let's jump into their most recent investor presentation and see a little bit more information about the company itself, and this is from their August 2026 presentation. So Realty Income is the 7th largest global REIT with a presence in all 50 states, the UK, and 8 other countries in Europe. As a quick overview, they have about $89 billion in enterprise value, over 15,000 real estate properties, almost 1,800 clients, and over 92 client industries. They do have a pretty good credit rating at an A- from S&P, and their total portfolio occupancy rate is fantastic at almost 99%, which is pretty ridiculous. They are a relatively diversified REIT. They do focus mostly on retail across multiple different companies, but they also have been getting into data centers and industrials more in the past couple of years. This graph right here shows some of their diversification with their top 20 clients. So you can see here their number 1, 2, and 3 are Dollar General, 7-Eleven, and Walgreens, which is not too bad, although Walgreens is not my favorite pick. Now, my favorite picks from this list, and I hope they can continue growing their relationship with these clients instead, is BJ's Wholesale Club, Home Depot, and Walmart. Regardless, one thing I do want to point out is that they don't just buy any property from any of these companies. They do try to pick prime locations where they have a better chance of having successful client relationships with long-term leases. If you do live in the US, I'm sure you've seen some Walgreens locations around you that have closed. I've seen a lot of them myself, but they tend to have some more prime locations that do a little bit better financially. In terms of industry, you can see they're pretty diversified. Grocery is their heaviest sector, but even that is not too bad at about 11.1%. Now, in terms of triple net lease, I did mention this term before, and we'll cover it here because the next stock we're going to look at is also doing triple net leases. So what it does is that means that clients are responsible for property taxes, insurance, and maintenance on the property, leaving Realty Income with not too much to take care of from an actual property standpoint. Now down here we can see the reasons as to why that's so advantageous for realty income. Vacant units can be sold individually, vacancies can be released for a variety of uses, vacant units can immediately be redeveloped, client pays the property taxes and all property expenses, client is responsible for capital expenditures, and lease contracts lack co-tenancy clauses. Now, like I mentioned before, their occupancy rating is at about 98.8%, which is pretty ridiculous, especially compared to the rest of the industry. We can see right here is at about 94.9%. It has fluctuated a bit over the years, crashing during the 2008 crisis, but since then, it's basically recovered and stayed pretty high for many years now. In terms of their recapture rate, they're at 103.2%, so I'm not too concerned with them going forward. I think they're going to continue being able to recapture these leases and extend them over the next decade or so. Now let's take a look at these couple slides right here. So they are expanding their global presence, and that's because they find it to be a good opportunity for them to grow long term. In the US, they do have properties across all geographic regions with some of the largest presence in the Midwest and Southeast, with a lot of room to expand from what it's looking like in the Pacific Northwest. Now, in terms of Europe and the UK, their biggest presence right now is the UK at 390 properties, but I expect them to continue to expand in Europe, which is currently sitting at 281 properties. Now, for many investors that look to invest in REITs, the reason for that is their dividends. They have a high starting dividend yield at about 5.2% in the Realty Income's case, and their compound annual dividend growth rate has grown at about 4.1% since 1994, which is pretty strong. Now, one thing I do want to mention, which I think is important to note here, is over the past couple of years, their dividend growth has slowed down pretty significantly, much closer to about 3% or less dividend growth rate. Now, once those headwinds from interest rates do come down, I believe their expenses are going to come down significantly as well, and they'll be able to continue growing their dividend at faster rates once again, but only time will tell. The thing I like about Realty Income is that they do pay dividends on a monthly basis, and they also grow their dividend at multiple points throughout the year. Now, real quick, let's take a look at some of their financial metrics. These are not the most relevant. We'll have to jump onto Seeking Alpha as well to see funds from operation. But in terms of revenue per share, it's gone up over time, which is pretty good. The earnings per share have been pretty flat, and the free cash flow per share has gone up in recent years. The most relevant metric I want to take a look at here is shares outstanding, and you can see that's basically exploded over the past 10 years, which is pretty ridiculous to see. For most of the stocks I invest in, what I like to see is a decreasing trend line of shares outstanding, with it going down significantly over time. However, for Realty Income's sake and a lot of other REITs, their shares outstanding tend to go up over time as they raise capital to buy more properties. Now, this is good and bad. The reason it's bad is because as they release more shares outstanding, your ownership stake in the company goes down, and it puts downward pressure on the per share metrics. Now, the reason it can be seen as good is because it helps them avoid taking out too much debt at high interest rates, so they can raise capital by just selling shares to the open market. Just to give you some perspective, this is what AutoZone's shares outstanding look like. They are one of the most impressive share repurchasers in the market, and it's gone down tremendously over the past 15 to 20 years, with it being almost half of what it was in 2013. Now, of course, there's reasons for this. They do operate in completely different industries with different economics, but it still is pretty crazy to see. Now, the second company I want to cover today is AgreeRealty, ticker symbol ADC. Now, AgreeRealty and Realty Income are competitors basically operating in the same market. Now, taking a look at performance, over the past 5 to 10 years, it has performed better than Realty Income. It does have a smaller market cap, so it is able to grow a little bit quicker than Realty Income, which is a pretty big advantage. I should also mention that their starting dividend yield is lower at 4.23%, but it's been growing pretty well, a little bit faster than Realty Income over the past 10 years. Regardless, even for AgreeRealty, over the past year, they're basically flat. They did peak at about $82 per share, which is pretty impressive, up 12% at some point during the year, but since then they've come down pretty significantly. Over the past 5 years, the company is not in the red, but it's flat, which is still not great to see. It did get as low as $54 per share, which is where I was purchasing my position within the stock, but since then it hasn't really done too much. You can see here that from 2024 till now, it's basically been flat, which is a little bit disappointing. Now, when I did originally purchase both these stocks, I was hoping that interest rates would come down faster than they have had so far, but as you can see, it's been a pretty slow crawl. Now, taking a look at their investor presentation, the main thing I want to highlight here is their tenants, because that's the big difference between Realty Income and AgreeRealty. For the most part, the rest of their metrics are pretty similar. Also, make sure to stick around in the video. We're going to be taking a look at my individual positions in both these stocks pretty soon. So me personally, I do prefer AgreeRealty's tenant mix a bit more than Realty Income's. Now, of course, they are smaller, so they're able to make more targeted acquisitions, and that does shape their tenant mix a lot more than Realty Income, who already has a much bigger property base. In terms of overall sector distributions, it's similar with groceries being about 10% of their sector volume, but we can see here the actual tenants are pretty different. We have Dollar General towards the top at 3.7%, but their number one position is Walmart at 5.8%, followed by Tractor Supply at 4.7%, which I much prefer. They also have some other strong names here like O'Reilly, TJX, Best Buy, Kroger, and Lowe's, which is pretty nice to see. Overall, I think the diversification here is a little bit better and safer in the long run, so we'll have to see how it plays out. In terms of their financial metrics, we can see that revenue per share has grown pretty quickly over the past 15 years or so, and that earnings per share have been pretty flat, just like realty income, with the free cash flow per share growing. Regardless, like I mentioned before, the main thing I want to point out here is the shares outstanding, and they've been increasing rapidly over the past 10 to 15 years. You can see it might be even faster growth than what realty income has experienced. Now, of course, it's for the exact same reasons as realty income, so we don't have to delve too deep into this right now. Jumping into Seeking Alpha, we can take a look at their adjusted funds from operation per share, and this is an important metric to look at for any REIT. Now, the reason it's really important, especially for a company like AgriRealty, is as they dilute shareholders by putting out more shares outstanding, your per share metrics are going to come down. Now, since their AFFO per share has gone up over the past 5 years, what this shows me is that it has been worth releasing more shares and selling more shares to the open market and diluting shareholders because the growth they've experienced has been more significant than the amount of dilution they've done. So as a shareholder, I'm not too concerned about the shares outstanding going up as long as I'm getting more value in return. Jumping into my Roth IRA portfolio holdings, I don't show this very often on the channel because my main focus is my taxable account, but we can see both my positions here in ADC and Realty Income, and I have them organized from highest total return to lowest. Now, my realty income position is significantly larger at $3,700 versus my $1,600 in Agree, and I do regret it just a little bit because I think Agree so far has been a better performer, and I believe it's going to continue performing a little bit better over the long run. Now, my cost basis for each is shown here, and I've had price appreciation on both, but not very significant. Now, I haven't been on top of my dividend reinvestments for quite some time, so I probably own more shares than shown right here, but this was the amount of shares I originally purchased, and with dividends reinvested, it would be in this column once updated. So one thing that has gone well for my investment in both these companies is that I've gotten both a price return and a dividend reinvestment return so far, which has amounted to these total returns you can see right here. In terms of total dividend earned so far, I've earned $129 from ADC and $392 from Realty Income, which is pretty strong. And every year going forward, I should be earning about $194 from Realty Income and almost $70 from ADC that I'm investing right back into the stock. Now, in terms of what yield that is, it does give me a 4.28% dividend yield on AgriRealty with a 5.66% yield on cost and a 5.18% yield on Realty Income with a 6.21% yield on cost. Now, before we do end this video, I did promise I'd have one bonus REIT that I would show you in this video, and this one is in a completely different sector. It's more of an industrial REIT, and it's called Rexford Industrial Realty Inc., ticker symbol REXR. Now, I'm not going to do a deep dive on this one in this video. If you guys want to see more information or a deeper dive on it in a future video, definitely let me know in the comments down below and I'll be sure to get to it. In terms of their financial metrics, most of them have been going up and to the right, which is pretty nice to see, but of course their shares outstanding have been getting diluted over time. In terms of dividend payments, it has been pretty strong over the past 10 to 15 years, which is something I look for when I'm investing in a REIT. Overall, this company carries, in my opinion, a little bit more risk than Realty Income and AgriRealty Corporation because of the industry that they're in, but it still has opportunity for growth once those interest rates do come down. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at my positions in Agri and Realty Income and my thoughts on the two companies. If you did make it all the way to the end of the video, let me know down below whether you own any REITs or have plans on buying any in the future. If you haven't yet watched last week's video where I cover my huge portfolio milestone I recently hit, check out this video right here. And if you want to see my dividend income for the month of July, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.